Hello, everyone. Welcome to the Morgan Hill Real Estate 2011 Retrospective Market Analysis. My name is Robert Whitelaw, and I'm a licensed real estate broker in the state of California and a member of the National Association of Realtors. I'm also the president and CEO of Whitelaw & Sons Real Estate Services. I hope I can pull myself together if we're going to make it through this whole thing. There's a variety of ways to get in contact with me. Probably the best ways are at my website. You can find those at www.soldbyrobert.com or at www.therebelbroker.com. If you prefer to contact me via email, you can just send those to robert@soldbyrobert.com. Or if you prefer to call direct, just dial 408-852-0525. Now, I'd also like to take a minute here to let everyone know about my live internet radio show that plays every week at blogtalkradio.com/rebelbroker. It's played live every Friday at 10 a.m. That's 10 a.m. Pacific time. So if you'd like to join in, there's a toll-free number to call in. We talk about all the important real estate issues of the day and how politics is affecting real estate, and how the market is coming along in general across the country, and what things might help you as a buyer, seller, and investor navigate your way through the world of real estate. So feel free to join in. We'd love to see you. And remember, you can call in live from a toll-free 800 number and participate in the show or even listen to it through that number. If you prefer to get in contact with me via AOL Instant Messenger, Google Talk, or Yahoo Instant Messenger, you can use the screen name The Rebel Broker to do that. And if you're a Skype user, just use the screen name Rebel Broker. Now, referrals are always appreciated if you or anyone you know is interested in buying, selling, or investing in real estate in the Southern Silicon Valley area. Please feel free to get in contact with me. I'd be happy to help you any way that I possibly can. Now, I can also help you if you're looking for real estate agents outside of my area. I am happy to go through the process of interviewing the agents in your area that will do the best job for you and then sending them your way. So feel free to contact me if that's something you'd be interested in having me do for you. Let's go ahead and jump in and take a look at the numbers. I know it's been a long time since the last time we did one of my market analysis videos. Last year was just a very busy year, and I had a tough time finding time to do this while doing the rest of the things I have to do on a day-to-day basis. But it was a good year in general. We had some pretty bad years over the course of the years I've been doing these things, but we had some pretty good numbers. Now, this particular slide is going to be just numbers for the entire year that's noted. So keep that in mind as you look at it. Now, the numbers we'll be looking at are for the total inventory. That means every home that's on the market, every home that was in the inventory, what the total inventory was for the year, the total number of homes that were listed. And so this gives you the difference between those two would mean a house could be in the inventory for 2010, but not listed in 2010. So say a house was listed in 2009, it would show up in inventory, but it wouldn't show up in listed for that year. So it gives you an idea of how much carryover there is from year to year. Then finally, we're going to look at the number of homes that sold, and I think that's pretty self-explanatory. If a house sold in 2010, it'll show up in the 2010 column. All right, let's go ahead and take a look at those inventory numbers first. We can see we really peaked out in 2008. From 2010 to 2011, we did see an increase. That went up 17.77% from last year, from 2010 to 2011. That was a 301 home increase for the total inventory. Now, the total homes that were on the market in 2011 were 1,995. Not the direction we'd like to see it going. You can see we really took a big drop from 2008 to 2009. It was really sort of shocking by how much we declined as far as inventory was concerned. But it would have been nice to see relatively flat performance from 2010 to 2011. So not as bad as it could have been. We saw an increase, but at least it wasn't a dramatic increase on par with the decrease we saw from 08 to 09. Let's go ahead now and also look at the inventory, listed numbers. These are the homes that were listed. Now, the good news is this number has remained relatively flat. The total number of listings is down from 2010 to 2011. So you might want to ask the question, where did those inventory numbers come from? Obviously, we carried a lot of them over from 2010. What's interesting is the sales numbers that we'll look at here. I'll go ahead and put those up now. You can see that sale numbers were a little bit lower last year than in 2010 than in 2011. But clearly we had a lot of carryover from previous years as far as homes that ended up staying on the marketplace that we then added to in 2011. So it's good that we actually saw those sales numbers increase. Now, the total number of listings was down 4.74%. That was only 33 fewer homes listed in 2011 than in 2010. Gave us a total of 663 homes that were listed for sale in 2011. The total of homes sold is up 6.31%, which is good news. That's 26 more homes sold in 2011 than in 2010. Now, if we take a look at these numbers and extrapolate from this how long it would take us to sell all of these homes if the numbers stayed like this. If we take these year numbers and we sort of plug them in, you basically take the number, the inventory number, and divide it by the total number of homes sold, and that'll give you an idea of how long it would take you to sell off all of these homes. And it would be about 4.5 months, given these numbers. We're also going to do the same thing with the month-to-month numbers for 2011, which is going to bear out just about the same number. So that's actually not a bad number. 4 to 5 months of inventory on hand is not horrible. I'd prefer to see 3 months as a ballpark, but we're not so far out. We're not seeing nearly the crazy numbers we saw in 2008, where we had over a year at some points of homes, of months of inventory on hand, meaning we would have had to, if everything froze, if the inventory number froze on the solds per month number froze, it would literally take us over a year to have sold out the entire inventory. So thank goodness we don't have that problem to deal with, but it would be nice if that number was just a little bit lower. In 2010, that ratio was 4.1 months. So a little bit of a decline as far as what we would like to see in that number from 2010 to 2011, but it didn't change enough, I think, to really cause anyone to panic. Now let's go ahead and take a look at the same numbers, but now this time we're just going to look straight back on months. So this is going to go all the way back to, this is January to December of 2011. We'll start off with those inventory numbers again, and this follows the typical path that we see for inventory. It's a very seasonal number. When we're in the winter months, it tends to be lower. When we're in the summer months, it tends to be higher, simply because people get that. People want to move in the summertime, so they tend to list their homes in the summertime. Buyers come out then. No one likes looking at a house in the rain. No one likes selling their house in the rain. So those properties tend to go off of the market, and the inventory tends to go down. Now, when we add in the homes listed during the month, you can see that this also bears that out. Fewer homes tend to get listed in November, December, January, February than the peak months in the middle of the year. We do see, though, with the change in the marketplace, people jumping into the marketplace quicker. January and February, we're seeing more people coming onto the marketplace than in past years. I think because during some of the really down years from 2007, 2008, 2009, we saw the selling season come earlier. Buyers came out earlier. So I think sellers have kind of clued into that and are tending to put their houses on the market a little bit earlier. March, April timeframe is still when folks first start thinking about it, but really, by and large, it's April and May, historically, when people have really started to put their homes on the market. And we can see we do get that sort of an increase during this time of the year. Finally, let's go ahead and put solds up. Kind of interesting numbers on the solds. Usually solds go along with inventory in terms of going down during winter months because fewer people come out to do it. We didn't see that in December of 2011. We actually saw a dramatic increase in sales. And look at sales versus listed. We sold twice as many homes as we listed in December of 2011. That's an outstanding trend. Anytime you can see more homes sold than were listed, as we did in November and December, that's excellent news. We haven't seen numbers like that in quite some time. You can see back to August, they were almost even, which is kind of interesting. It's interesting that number of people would have listed their homes in August. But the overall numbers here are actually pretty good. The inventory from November to December was down 10.73%. That's 19 fewer homes on the market in Morgan Hill in December than in November. The number of homes that were listed was down 43.24%, and that's 16 fewer homes listed in the month of December than in the month of November. And finally, sales were up 12.82%. That's 5 more homes sold in December than in November. I think that increase really sort of indicates, and I sold one of those homes that sold in December of 2011. So I know that from being out there in the marketplace, talking to buyers, making offers on homes, there were a lot of people who saw that time period as a way to get a really good deal on a property in Morgan Hill. So I think we had an elevated number of folks out there buying later in the year than is typical. It didn't hurt that we had a relatively mild winter, or at least early winter in Morgan Hill, so we didn't have some of the crazy weather that we have seen in past years. So it made it a little bit easier for buyers to stick to it, go out there and look at properties and make some offers. Now let's go ahead and look at the short sales and foreclosures numbers. This is an interesting thing to take into consideration, simply to see how much the market is diced up. Now these are the homes that sold. 55% of the homes that sold were conventional homes, meaning they weren't short sales or foreclosures. Short sales made up 27% of the homes that sold, and foreclosures made up 17% of the homes that sold in 2011. Sort of an interesting number to consider. The big thing we're looking for here is what the relationship is between conventionals and then the other stuff. It would be nice if conventional came a little bit further along. If you listen to the podcast or the live online show that I do every Friday morning, we talk a lot about where to find your best deals depending on what your marketplace is doing. I know here in Morgan Hill, one of the most underexploited areas was conventional sales for a long time, where I could have someone dedicated to the idea of buying a foreclosed or short sale property with all of the downside that's associated with that. But then another one of my clients would be more open-minded, and I could find them a conventional sale where I could negotiate the price down to short sale or foreclosure levels without any of the associated downsides that you get from the short sales or foreclosures. So I encourage people to go out there and look at your marketplace and be willing to be an aggressive negotiator. You can often buy yourself a home in a conventional way that doesn't have a lot of the headaches that come from buying a short sale or foreclosed home. Let's go ahead and compare this to the previous year, or 2010. We can see that conventionals took a couple of more points of the marketplace. That's a good thing. I like to see conventional sales representing more of the market. Foreclosures were down and short sales were down, but short sales were only down by 1%. Foreclosures were down by 2%. Interesting to note that short sales that's another thing we've actually talked about in the weekly show, is Bank of America in particular has very aggressively been going after short sales. Now, that hasn't been so much the truth here in my area, but we've seen sort of a change, sort of a flip in how banks are at least starting to address short sales, which is making them potentially a better deal for buyers. They've actually been very difficult and frustrating for buyers in the past, but we've seen some very interesting changes. And looking at this, you can see that we've got 55% went conventional, 45%, 44% actually short sales or foreclosures in this particular marketplace. All right, let's go ahead and take a look at what home prices did over the years here. You can see that the average price, we're going to look at two prices here, the average price and then the median price. And think of the median as the price that is right in the middle in terms of number of homes sold. So in other words, if 10 homes were sold, the median price would be the price at which 5 of the homes sold below that amount and 5 of the homes sold above that amount. It kind of gives you, it's a way to think about where the bulk of the action happened. So if you had a marketplace where 9 of the homes, if there's 10 total homes that sold, if 9 of them sold over $1 million and 1 of them sold at $100,000, then you'd see that median way up there at over $1 million. It's a way to figure out where the most action has been. Where has most of the buying actually been taking place? Where is the cluster or the middle point, so that you can say, all right, well, if the median is up high, then you can say more homes were sold at the high end than at the low end, at least if you're using the median as a way to sort of define the high and low end. The average price has been doing typically what we've been expecting since 2006. It's been going down. The market started to take a hit in 2006 in Morgan Hill. Morgan Hill was sort of the canary in the coal mine for a lot of the downside of the marketplace. One of the first places that really got hit by price drops. We'll also go ahead and put the median in here. And you can see that the median has typically been lower, which means that while the average price may be $687,772 is the average price, or was the average price of a home in 2011. You can see that the median, though, is just a little bit below that at $569,999. That just tells you that there were more homes that sold below the average than above it. So you can see that there was still more action. There were still more buyers interested in making their purchases at the lower end of the price point for homes in Morgan Hill. The average home price decreased from 2010 to 2011 by 7.58%. That in dollar terms, that's $56,428. The median price change was down 4.2%. So you can see that the shift in where people were buying as far as price range is concerned wasn't as affected as the average price was. That went down 4.2%, and that's a $25,000 change downward in where that median was based. Let's go ahead now and take a look at home prices in past months. We'll be looking at the exact same numbers again, but just January to December of 2011 as we have with the previous numbers. Now we can see the average price from month to month tends to fluctuate quite a bit. We saw our highest numbers in July. That actually just makes sense. When you think about competitiveness, when you think about more buyers in the marketplace, June and July of 2011, I had several deals that ended up being multiple offer scenarios where I had buyers. In one case, it was a foreclosed property. In two other cases, it was a conventional property. Both of those ended up in multiple offer scenarios. And I had several clients where I made offers. One was also a short sale where they didn't end up getting the property because they didn't bid high enough. Someone else had outbid them. So much more robust as far as the market is concerned in terms of competitiveness in June and July. These numbers sort of reflect that. The average home price, though, from November to December increased 20.53%, which is a little bit odd. It's interesting to see average price jump that much at the end of the year. It's a little bit strange. You'll see that from July, we saw pretty steady decreases. It decreased in August. It was relatively flat from there in September, and then it was down in October and down in November. I wouldn't take that as suddenly a willingness for people to spend more or that the real average price of homes in December was up. The reason, because you'll notice the median didn't go up nearly as much. I think what we saw was folks who had more money to spend on a house and wanted to get the best deal they could ended up buying that higher end home at a very discounted price. So think of it this way. The average price may have gone up for that month, but it's because folks went out and bought that $2 million house for $1.1 million or $1 million. So it's still deal taking. It's just deal taking at the higher end of the spectrum, and that can sometimes throw these numbers off one way or the other. The median price from month to month from November to December was up 9.96%. That's a $52,680 change. The average price was up 20.53%. That's a $125,274 increase. That put us at $735,328 as the average price ending 2011 in December. But as we mentioned before, that the average for the year was actually quite a bit less than that, in the 600,000 range. Now let's go ahead and see how long it took to get a home sold in 2011, and we'll compare it as we have before with the previous years. You can see that in 2008, again, we had the peak of the bad news with 126 days to get a home sold. You can see back in 2004 and 2005, it was about a month to a month and a half to get those properties sold. And we haven't really seen those numbers since. A little bit interesting to see these numbers increase, but I think what we're seeing here is also whenever you see a big year where sales increase, you'll tend to see the days on market increase, and the reason for that is a little bit counterintuitive. It's because you're selling more than what got listed. So what you end up doing is pulling properties out of the existing inventory that may have been on there for a very, very long time. So when you tend to see an increase in sales, you tend to see an increase in days on market because you're reaching towards the bottom of the barrel. And I hate to phrase it that way. These aren't bottom of the barrel properties, but in terms of how long they've been in the market, the deeper they are in that bucket means they've been on the market longer. They're just much longer on the market properties. So when you're selling more, you're reaching deeper and pulling out properties that have been on that market for a lot longer than others. At the end, from 2010 to 2011, we saw a 15.29% increase in the days on market. That was 13 more days to get a home sold than the previous year. Now, in terms of days to sell just in past months, we'll go ahead and look at that just going from January to December of 2011. And we can see some tip ups and downs here in terms of homes that got sold. Now, remember what I told you about when you tend to see sales increase, you tend to see the days on market go up. Notice that December sort of bears that out. When you see the sales numbers increase, you tend to see these numbers go up. What's funny is when you tend to get more excitement going on with increased listings and increased sales in the summer months, it tends to be a little bit less the case. Simply because you're tending to sell properties that were listed, that are fresher listings. The fresher listings tend to go first. They tend to dominate the marketplace. So that's why you'll see some of these 77 to 89 day numbers. If you go back in July, 70 days prior would be 2.5 months. So that means those are folks who listed in March and April and then got their homes sold in July. So that's why you sort of see those numbers. Now, the days to sell increased 37.37% from November to December. That was a 37-day increase. Well, I hope you've enjoyed this retrospective of the year 2011 from Morgan Hill. I appreciate you taking the time to listen. Again, these are all the various ways to contact me. We went ahead and ran through them at the beginning of this particular video, so I won't run through them again. But if you'd like to get in contact with me, use any of these methods. I look forward to hearing from you, and hopefully we'll be doing another one of these real soon.